Okay, today we are going to start second mixed bank of BPP, in which we will do different questions related to different topics. A division of a service company is aware that its recent poor performance has been attributable to a low standard of efficiency among that workforce. So efficiency is low among the workforce. Compared to rival firms, the company is adopting a balanced scorecard approach to setting performance target. As part of its objective of closing the skill gap between itself and the rival companies, the division's management has set a target of providing at least 40 hours of training each year of all of its employees. So, what does this performance target reflect? Here we are focusing on our efficiency. Company is adopting to setting performance target as part of closing the skill gap between itself and the rival companies. So it will give benefit to whom? First one is customer perspective, innovation and learning perspective, then internal business. This will give benefit to the, or this will contribute towards the innovation and learning perspective. Which of the following could be included in a time series sales forecast? So whenever we want to make the time series forecast, we need trend analysis. Trend analysis is the one where we are analyzing the trends of each month, of each for each quarter or each year over the last 5 years, 7 years, or 10 years. Seasonal variation is the one where we are determining the variation in sales due to change of the season. Cyclical variation is the one where we are observing variation which is relevant with different types of businesses. For example, if we talk about construction business, there we will see cyclical variation. If it is going good, it will remain good for next 4 5 years. If it is in trouble, it will remain in trouble for the next 4 5 years. So this is the right answer. Which of the following is the best definition of return on capital employed? Return on capital employed is basically the profit before interest and tax divided by share capital plus equity plus long-term loans, or alternatively we can say that profit before interest and tax divided by non-current assets plus current assets minus current liabilities. So this one is the right answer. Ordinary shareholder fund plus non-current liabilities. Good quality saves money, but the cost of quality can be analyzed into cost of conformance and cost of non-conformance. Conformance cost is the one which is incurred on prevention and appraisal. Prevention and appraisal, where we are confirming that we are producing a quality product and after that we will deliver to the customer. Non-conformance is relevant with the internal failure, internal and external failure. Which of the following cost is closed as quality related appraisal cost? Quality related appraisal cost means what? Either it is reinspection cost, administration of customer complaint section, performance testing, training in quality control. Quality related appraisal cost. Appraisal cost is the one which is incurred after the production of the product, and we are testing the performance of the product, and then we will make sure either the product is meeting the quality standards or not. Which two of the following costs would be considered to be the responsibility of the manager of a profit center? Responsibility of a profit center manager. Profit center manager is basically responsible to maximize revenue and as well as to minimize cost. So the profit center manager will try to control those costs which are relevant and as well as we can say that controllable cost. Imputed interest on capital investment is a non-cash item and it is controlled or managed by a head office. Depreciation of machinery is an uncontrollable cost if because it is managed by head office, but at times depreciation could also be a relevant cost if the machinery purchased or sold by the departmental manager. Then we have in a period 12,250 units were made. There was a favorable efficiency variance of 11,250. If 41,000 labor hours were worked and the standard rate was $6 per hour, how many standard hours were allowed per unit? So this one is the reverse MCQ. Here we have 11,250 favorable is equal to total standard hours are missing minus actual hours are 41,000 into standard rate per hour is 6. So 6 will come and divide over here. So 11,250 divided by 6, 1875 favorable. So if it is 1875 favorable, it means actually we consumed lesser hours and standard hours were 1875 greater than the actual hours of 41,000. So the total hours, standard hours are 42,875. Question is how many hours are allowed to produce one unit? So standard hours is equal to standard hours per unit into actual production units. So now we can calculate 3.5 hours are the standard hours per unit. Next one is in the first year of operation, the company produced 100,000 units of a product and sold 80,000 units at $9 per unit. It earned a marginal costing profit of $200,000. It calculates that fixed production overheads per unit is $5. What profit would it have earned under an absorption costing system? So question is saying that we produced 100,000 units and we sold 80,000. Opening inventory is not provided in the question, so opening inventory is 0. But closing inventory is the difference between produced and sold 100,000 minus 80,000. So 20,000 units is what it is the closing inventory. If closing inventory is higher, it means profit under um, absorption costing will be high. So $5 OAR is multiplied by 20,000 units. 100,000 is the difference between profits under absorption and marginal costing. And here he is saying that our what would be our absorption costing profit? Marginal costing profit is 200,000. Due to no inventory, opening inventory, marginal costing will be lower, and the difference between profits is 100,000. So marginal costing profit will be $300,000. Sorry, absorption costing profit will be $300,000. Next, we have the table below contains detail of an airline expenditure on aviation fuel. Year 20x8, 20x9, total expenditure on fuel, total kilometers flown, fuel index. The following statement relate to the changes between 20x8 and 20x9. Quantity of fuel consumed increased by 140%. Quantity of fuel consumed by increased by 20%. And then he says that quantity of fuel consumed per kilometer flown increased by 20%. Quantity of fuel consumed per kilometer flown increased by 109%. Quantity of fuel consumed increased by 140,000. Here is saying that total expenditure is this and total kilometer flown is this much. So we don't know the quantity. We have to convert this cost divided by kilometers and we have to calculate the quantity. So 600 million divided by 4200 million, it is 0.142, and the second one is 1440 divided by 4620, it is 0.311. Although index is also different, but if I go with the same cost without a distinct index, then what is the rise in the cost? Rise in the cost is 219%. So this option is incorrect. Quantity of fuel increased by 20%. Okay. Now how to consume 20%? If we adjust our index 1440 with the current year index. So 1440 divided by 240 into 120, 720. So on the basis of this index, cost must be 720 million over here. So on the basis of cost, 720 divided by 600, yes, it is rise by 120%. So this is the right answer. The following statements relate to spreadsheet. Okay. Which statement is false? They are efficient method of storing text-based files. No. They facilitate what-if analysis. This is true. They allow data to be displayed graphically. This is also correct. They allow the font size and color of the text to be changed. This is also correct. So this one is false. This one is the right answer. JKB budgeted to sell 5,000 units of a product in November at a standard price of 30 per unit and to earn profit of $25,000. It actually sold 6,000 units at $20 per unit and earned a profit of $32,000. What was the favorable sales profit volume variance? Okay. What is the amount of budgeted sales units? Budgeted sales units are 5,000 minus what is actual sales unit? It is 6,000 into budgeted profit per unit is needed. Here he says that the total profit is 25,000 and budgeted sales are 5,000. So $25,000 is divided by 5,000. Here we have $5 per unit as a budgeted profit. Budgeted sales were 5,000. Actual sales are 6,000. Actual sales are greater into $5. So we have $5,000 favorable variance of the sales volume variance. If we are selling more units, it means it will increase our profitability. So that's why if something is rising your profitability, it is considered as favorable variance. Which of the following are benefits of the activity-based costing? Right? Activity-based costing, it recognizes overheads are not always driven by value of production, volume of production. It does not result in under or over absorption. This is true about the activity-based costing, but it is not considered as the benefit. It avoids all arbitrary cost apportionment. It does not avoid, it is basically using the cost drivers to divide the cost among different uh, products. It is particularly useful in single product business, no, not necessary. In fact, it is useful in multi-product businesses, not useful in single product. It avoids, not avoids. It does not result, it does result. So the first one is the right answer. Next one is an investment project has net present values are as follows. At 5% it is positive, at 14% it is again positive, and then it is 20% negative. Using the above figure, what is the best approximate of IRR of the investment project? So IRR percentage is lower discount rate plus highest NPV divided by highest NPV plus lowest NPV. It basically in original formula it is negative, but here we have negative, so the minus minus becomes plus into the difference between high and low discount rate. So now we will solve this bracket first. 16,000 divided by 26,500, 0.6037 into 6 plus 14, 17.62%. A company uses production labor hours to absorb its fixed overhead production overheads. Strike by its workforce result a loss of 30% of the period budgeted production labor hours. Which of the following variances will occur as a result of loss in the production labor hours? Following variances will occur as a result of the loss in the production labor hours. Loss of 30% of the period budgeted production labor hours. So if there is a loss, then what will happen? There will be adverse fixed overheads capacity variance. It means we paid the cost for budgeted fixed hours, but we could not avail the opportunity of budgeted hours. So that's why we are having fixed overheads capacity variance. Here he is saying that company uses production labor hours to absorb the fixed production overheads. A strike by its workforce and a loss of 30% of the period budgeted production labor hours. So it means if budgeted labor hours were 30,000 and actual labor hours are 70% of the 30,000, which is 21,000. So actually we are working for the lesser hours. So budgeted minus actual, when we are working for lower actual number of hours, it is called adverse capacity variance. Next one is a firm with non-current with current asset of $40 million and current liabilities of $20 million buy 5 million of inventory on credit, which increases its inventory level to 10 million. What will the effect on its current ratio and quick ratio? Okay, company has a current assets of 40 million and liabilities of 20 million, buy the 5 million inventory on credit. Currently, it is 40 divided by 20. Currently, it is 2:1. Then 40 plus 5 divided by 20 plus 5. 45 divided by 25, 1.8:1. So in fact, it is current ratio is not rising, it is reducing. By how? 2 minus 1.8, 0.2, and 0.2 divided by 2 into 100, it is reducing by 10%. So there are two options of reducing by 10%. It means these two options are incorrect. Now which one is correct? What would be the impact on quick ratio? Quick ratio is the one where current assets are 40 and we need to deduct inventory, but we don't know what is the level of inventory right now. Divided by what? We have the current liabilities of 20 and we are purchasing further inventory on credit by 5 million. Increase in inventory level. Okay, current inventory level is 10 million. Sorry, in fact, after buying 5 million, the revised is 10 million. So the current is 5. We will deduct current, this one 35. But in liabilities, there is an addition of 25. So the revised current assets are 35 divided by 25. It is 1.4 ratio 1. So this option is not correct, the unchanged one. Basically, it is also falling or it is also reducing. There is reduction in what? Reduction by, we can say it is more than in fact 20%, but here he is saying that 20 reduced by 20%. This is the right answer. Or alternatively, we can say if it is not the part of it. Anyways, this is the right answer. Then next one is a publishing company is researching the reading habit of the UK population. It randomly selects a number of locations from around the UK and then interviews everyone who lives in these locations. Randomly selects locations and then interviews everyone. But the location selection is random. Then they are interviewing everyone. This is called cluster. Systematic means they are choosing after every certain number of locations, like after every 7 locations. Quota sampling means they are choosing specific area. And stratified means they are not only random in the area, they are also interviewing randomly with the different people. But here they are doing what? They are interviewing everyone. Next one is BR company has a single product with a selling price of $12 per unit, which it calculates a variable cost per unit as plus 20%. At an output level of 5,000, it makes a loss of 8,000. What is the company's fixed cost? Okay. Selling price is what? 12,000, $12. The output units is 5,000. So 60,000 is the revenue. Here we have a loss of 8,000. This one is sales revenue. Variable cost, which is calculated as variable cost per unit plus 20%. So if we assume that variable cost is like 100% plus 20% means this $12 is showing 120%. So I have to calculate 100% out of this 120% to calculate what the variable cost is, and it is 10 into 5,000. It is 50,000. And he says that we are in loss by 8,000. Here we have a contribution of 10,000, but there is a figure which we deducted from the 10,000 and there is a loss. This figure is 18,000. If we deduct 18,000, there is a loss of 8,000. So this one is the right answer. Any question? Next one is, what is the sales price variance? To calculate the sales price variance, we need to convert our revenue divided by units, it is 10. This one is divided by actual sales. 11. Sale price 10 minus actual sales 11 into actual sales, sorry, budgeted sales price minus actual selling price into actual sales. So there is $5,200 favorable, because actually we are charging greater amount of selling price rather than the budgeted. What is the sales profit volume variance? Okay. Budgeted profit is 5,000, 20,000 divided by 5,000. It is 4. Budgeted sales units are 5,000 minus actual sales units are 5,200 into 4. So 800 is the favorable because we are selling actually more units than the budgeted. SJC has used linear regression analysis to establish the relationship between total cost and activity in units. What does the slope of regression line represents? Slope of regression line always represents variable cost per unit. A division has a capital employed of 12 million, 2 million and earns an operating profit of 600,000. It is considering a project that will increase operating profit by 20,000, but would increase its capital employed by 80,000. A rate of 15% is used to compute interest on capital employed. What will be the effect on residual income and return on capital employed if the decision accept the project? Okay, residual income. How to calculate the residual income? Residual income is expected profit minus actual profit. How to calculate expected profit? Capital employed into cost of capital. We have 2 million, but would increase its capital employed by 80,000. So if I calculate only the incremental 80,000 into 15%, it is 12,000. Expected profit is 12,000, or you can say actual operating profit minus expected profit. So here we have what? 8,000 residual income. So residual income is rising, increasing. It means these two are incorrect. Now which one is correct? Return on investment Operating profit is 600,000 previously, and previous investment is 2 million. 600,000 divided by 2 million into 100. So 600, it is 30%. But now we are saying that additional will be 20,000 after against additional investment of 80,000. It is 25%. So it will fall. This is the right answer. What is your question? So once the question asked about sales price variance, we have to divide it by units. Yes. If question is written in this form, where total revenue is provided, budgeted, and total is provided actual, you will divide it by the budgeted sales units and actual sales units to convert into budgeted selling price per unit and actual selling price per unit. You will divide it by the units to calculate budgeted profit per unit, and there is no need to calculate the actual profit per unit. Then you can solve sales price variance and sales profit volume variance. Right? Any question?